The average retail investor earns 4.3% on their income portfolio. The average institution earns 12%, same market, same year, different architecture. That gap has a name. Most people who watched our last briefing did something predictable. They wrote down the 7 assets, they opened a brokerage account, and then they stopped. That's the trap. Because the 7 assets we audited in Phase 1, REITs, BDCs, covered calls, bond ladders, those are the foundation layer, the floor. And a floor is not a system. A system has a throttle. Today we are going deeper. We are auditing 3 assets that I deliberately left off the first list. Not because they are dangerous, not because they are complex, but because they require a different level of architectural intent. One of our viewers asked exactly the right question. He said, why were preferreds and CLOs excluded? They weren't excluded. They were reserved. This briefing is for the builders who have already built the floor and are now ready to install the engine. If you are still debating whether to start investing, this is not your episode. Go back to Phase 1 video. The link is in the description. But if you are ready to compress a decade of compounding into 4 years, stay with me. Let's begin. Here is what the financial media gets wrong about advanced investing. They frame complexity as danger. CLOs are risky. Preferreds are confusing. Only institutions should touch these. Think about that. The same institutions generating 10 to 15% annual yield on structured credit are telling retail investors to settle for 4%. That is not a warning. That is a wall. The sophistication trap is the belief that higher yield automatically means higher chaos. It doesn't. It means higher structure. The most advanced income systems are often the most mechanically sound, once you understand the payment waterfall. In 2008, the problem wasn't CLOs. The problem was the underlying assets inside them, subprime mortgages with no documentation standards. The structure itself was not the failure. The inputs were. That distinction matters, because in 2026, with institutional-grade loan pools and stricter underwriting, the structure has been rebuilt, and the yield premium still exists. The question is not, are these assets safe? The question is, do you understand where you sit in the payment queue? That is the diagnostic frame we are operating from today. Let me be direct about why Phase 1 did not include these 3 assets. It was a sequencing decision, not a risk decision. If you do not understand our rates, you should not be in CLOs. If you have not built a covered call position, you are not ready for preferred stock laddering. You need the foundation before you install the engine. That is how architects build, not from the roof down, from the ground up. But here is the inflection point. If you are a late starter, if you are 42, 47, 51, and you have already deployed the Phase 1 assets, you are running out of time to rely on a 5% yield and a 30-year compounding horizon. You need a throttle. These 3 assets are that throttle. They do not replace the foundation layer. They sit on top of it. They amplify the rotation speed of your capital. Stop for a moment. Audit your portfolio right now. Are you at the floor? Or are you building the engine? Let's define what the engine looks like. Asset number 1, preferred stocks. Think of the corporate capital structure as a building with 3 floors. The ground floor is debt, bondholders. They get paid first, always, regardless of what happens to the business. The top floor is common equity, shareholders. They get paid last, when there is anything left. The mezzanine, the middle floor, is preferred stock. You sit above the common shareholders. That means if the company distributes cash, you are in the queue before the person who owns the regular stock, often at a fixed rate of 5 to 7%. Quarterly, predictable, structural. Now here is why this matters for a late starter. You are not speculating on whether the stock price goes up. You are collecting a predetermined yield based on your position in the payment hierarchy. The price volatility of the common stock is noise. Your check still clears. The risk is interest rate sensitivity. When rates rise sharply, preferred prices fall because fixed-rate instruments reprice. That is the known variable. The mitigation is simple. Build a preferred ladder across multiple sectors, utilities, financials, real estate, with staggered call dates. No single position dominates the floor. That is the mezzanine layer. Asset number 2, collateralized loan obligations, CLOs. I want to address the 2008 reflex immediately. CLOs are not CDOs. They are not bundles of subprime mortgages. They are pools of senior secured corporate loans, debt issued by established businesses to fund operations and acquisitions. The underlying assets have first lien priority on corporate assets if the borrower defaults. The CLO structure then divides that pool into tranches, layers of risk and return. A tranche at the top, lowest yield, highest protection. B and BB tranches at the bottom, highest yield, first to absorb losses. For a builder operating a structured income system, the focus is the BB and B tranches, where current yields are running 10 to 15% annually. This is not a rumor. This is the published distribution data on publicly traded CLO equity vehicles. The mechanical reality is this: you are acting as the capital provider to corporate America. Companies borrow. You receive the interest payment. The payment priority is contractual, not discretionary. The risk is default correlation. If multiple companies in the pool default simultaneously, a systemic credit event, the lower tranches absorb first. The position sizing rule, CLO exposure should not exceed 15% of your total income portfolio. It is an engine component, not the entire engine. Asset number 3, the managed distribution vehicle. Specifically, the interval fund and the closed-end fund structured for total return distribution. Here is the diagnostic question most retail investors never ask. Is this fund distributing income, or is it distributing my own capital back to me? That distinction separates a wealth system from a wealth illusion. A legitimate managed distribution vehicle, think closed-end funds focusing on senior loans, credit income, or infrastructure debt, generates yield from the underlying assets. The distribution is real, it is recurring, and in many cases it is structured to maintain principal. The key metric to audit is the coverage ratio. If the fund is paying out more than it earns, the distribution is unsustainable. That is return of capital masquerading as income. A coverage ratio above 100% means the fund is earning more than it distributes. That is the signal. For a late starter building a 15% blended yield system, this third asset class functions as the stabilizer, the bridge between the structural certainty of preferreds and the amplified return of CLO tranches. Let me now address the architecture of how these three assets work together. If you are 45 years old with $80,000 deployed in Phase 1 assets, REITs, BDCs, a covered call overlay, your current blended yield might be sitting at 6 to 8%. At 7% on $80,000, you are generating $5,600 per year in passive income, $467 per month. That is a start, not a system. Now you add the Phase 2 layer. A 15% allocation to preferred stocks, a 10% allocation to a BB-rated CLO vehicle, a 10% allocation to a high-coverage closed-end fund. That additional 35% of your portfolio, approximately $28,000, is now generating at a blended 11 to 13% yield. Your total portfolio yield moves from 7% to 9.2%. On $80,000, that is $7,360 per year, $613 per month. Not glamorous, structural? And in 8 years at consistent reinvestment, without adding a single additional dollar, that $80,000 becomes $160,000. The income doubles with it. That is the throttle. Stop optimizing for price appreciation. Start optimizing for rotation speed. Every briefing requires a risk audit. This one is no different. 3 known risks, 3 known mitigations. Risk 1, liquidity. CLOs and interval funds are not liquid assets. You cannot sell them on a Tuesday because the market dropped. If you need capital access within 12 months, do not deploy into this layer. Stay at the floor. Risk 2, interest rate sensitivity. Preferreds and closed-end funds reprice when rates move. A rapid rate increase compresses their market value. The mitigation is duration laddering. staggering maturities so no single repricing event dominates your income stream. Risk 3. Credit correlation. A systemic corporate default cycle impacts CLO tranches. The mitigation is position sizing, never exceeding 15% CLO exposure in your total portfolio. Know your risks, name them, then build around them. That is not pessimism. That is architecture. Stop for a moment. I want you to audit yourself right now. Not your portfolio, you. Answer this question honestly. When you heard CLO at the start of this briefing, what was your first instinct? If it was, "That's too complex for me," that is the sophistication trap talking, not your intelligence, the trap. If it was, "Tell me more," that is the builder operating system. That is architectural intent. Drop a comment below. One word only. Floor, if you are still building the Phase 1 foundation. Engine, if you are ready to install the Phase 2 layer. I read every comment in this channel. I need to see where you are in the build. Because the next briefing I release will be determined by where most of you are standing right now. Your one word shapes this channel's direction. Use it. Here is the final diagnostic. The 7 assets from Phase 1 give you a floor, a monthly income baseline that does not depend on a salary. The 3 assets we audited today give you a throttle, the ability to compress a 20-year compounding timeline into 8. Most people will watch this briefing and do nothing. They will nod. They will feel informed, and they will return to the same portfolio they had before pressing play. That is the drift. Builders don't drift, builders audit, builders position, builders act with architectural intent. You now have the diagnostic framework, preferred stocks for the mezzanine layer, CLOs for the waterfall yield, managed distribution vehicles for the stabilized floor. The Phase 2 engine is now in your hands. One more thing before you leave. If this briefing gave you clarity, share it with one person in your life who is asking the same questions about money in this economy. Not because it helps the channel, though it does, because clarity at this level is genuinely rare, and the people you care about deserve to have it too. Take care of your income. It will take care of everything else.